Your mortgage payment and your monthly homeownership costs are about to change, and for most of you, it's a complete trap. On March 18th, 2026, the FHFA officially authorized a massive policy shift. They're now allowing lenders to accept actual cash value policies instead of replacement costs. This is absolutely huge. Fannie Mae and Freddie Mac literally just hit the undo button from those 2024 mandates. This is right now being marketed as a way to lower your monthly bills and save you some money. But in reality, it's a systematic shift of risk from the big banks onto your shoulders. And if you are a new homeowner or you're living on a tight budget right now, like so many, you are now one storm away from financial catastrophe. And today, we're going to go straight into the math, the trap, and the 3 defensive moves that you need to make right now to protect your home's equity. Guys, this is a little confusing, so let's just get right into the meat and potatoes. For decades, the gold standard of homeownership was replacement cost value. If a storm would hit your roof, the insurance company pays for a brand new roof. They quote, yeah, I have insurance. That's what that meant. They pay 2026 labor rates, they pay the 2026 material costs, and you get to pay a smaller, a little larger deductible. And then you're whole again. Under these new 2026 guidelines, we are moving back to actual cash value. In the industry, we call that garage sale value. If your roof has a 30-year lifespan and it's 15 years old, the insurance company is only going to pay you 50% of what that roof is worth today. The best way to explain this, guys, is to just do the math. So let's look at the numbers. A new roof costs $20,000. Depreciation of 15 years, being 15 years old, is about $10,000. Your deductible would be $2,000. Your insurance check is $8,000. Your out-of-pocket gap is $12,000. That gap is the insurance trap. You might save $50 a month on your premium, but you are effectively self-insuring the most expensive part of your home. And for those of you that are soon to be home buyers or new homeowners right now, you need to actually start reading what you are getting with your current homeowners insurance policies. Qualifications are really tough right now, especially if you're pushing the top end of your budget, if you're looking to buy. And it may be a little tempting for your mortgage lender and your insurance agent to give you one of these actual cash value policies instead of replacement cost policies because they cost more and affect your debt to income. They would do this just because they want to help you qualify for a house that you want so bad. So before you buy a home, buyer beware, start getting educated on homeowners insurance policies. The question is though, guys, and this is important, why is this even happening now? Well, because the insurance world is breaking apart. Between 2022 and 2026, we've seen the triple threat. Construction inflation has outpaced everything else. Plywood and shingles cost double what they did 5 years ago. Then you have climate volatility. Here in the Midwest, we've always dealt with those Mitten winters. Heavy snow loads, ice dams, 70-mile-an-hour wind gusts, tornadoes. They just seem to come out of nowhere. The state's flooding right now as I'm recording this up north. But now the insurance companies are tired of paying for what they call maintenance. By allowing actual cash value policies, the government is letting insurance companies completely off the hook. They're forcing you to be the developer and the maintainer of your own property for good. Here's a quick pro tip for your insurance agent that they might not tell you, but I've already checked, so you might not have to. Check your wind and hail deductibles. In 2026, many policies have moved to a percentage-based deductible. If your home is insured for $400,000 and you have a 2% wind deductible, you have to pay the first $8,000 out of pocket. Now, add that to an actual cash value policy. If your roof is depreciated by $8,000 and your deductible is $8,000 and your total job is $20,000, you're looking at a $16,000 bill before the insurance company pays you a single dime for your roof. This is how being insured right now, guys, becomes functionally uninsured. If you switch to actual cash value to save money, you must negotiate for a lower flat fee deductible. Please do not get caught in the percentage trap. Guys, look, you need to take control of your finances. Here are the 3 things that we're suggesting that you start doing this week. Step 1, the mid-year escrow audit. Don't wait for your escrow shock letter this December as you're buying Christmas presents. Call your mortgage servicer right now. Ask for a mid-year analysis. If your premium went up, start paying the difference today. And then step 2, guys, get a roof certification. This is huge. Get a licensed contractor to do a condition report with high-res photos. In an actual cash value world, the adjuster's biggest weapon is saying your roof was already failing. A certified report from today is your receipt of quality. It gives you the leverage to finally fight back against the insurance companies. Step 3, guys, the sinking fund. If you choose the cheaper actual cash value policy, that savings is not found money. It is roof money. Automate a transfer of savings to a high yield account Treat your home like a subscription service. If you aren't paying the insurance company to take the risk, you have to pay yourself. All right, guys, look, the American dream used to have a safety net. In 2026, that safety net is being retracted. We are entering an era of active homeownership. The shift hits the little guy the hardest. The person who scraped together 3% for a down payment and doesn't have any cash left over for repairs, you're at risk. I'm not telling you this to scare you. I'm telling you this so you can pivot. Your true monthly cost is no longer just your mortgage payment. It includes the gap the insurance company just created. Guys, the Mitten grip is all about holding on when things start getting slippery. The government just made the housing market a lot more slippery. Check your deck pages with your insurance provider, audit your escrow, and stop treating your insurance policy like a piggy bank, because that bank is officially closed. Guys, hit the subscribe button to stay ahead of the curve. We'll see you guys in the next one.